Hi everyone, welcome to my channel. If you came for the first time, then please do subscribe and click on bell icon. In today's video we are going to discuss about the cash out refinance. The first question that might come to your mind is, what is cash out refinance mortgage? A cash out refinance is a mortgage refinancing option that lets you convert home equity into cash. A new mortgage is taken out for more than your previous mortgage balance, and the difference is paid to you in cash. In a cash-out refinance, a new mortgage is taken out for more than your previous mortgage balance, and the difference is paid to you in cash. You usually pay a higher interest rate or more points on a cash-out refinance mortgage compared to a rate and term refinance, in which a mortgage amount stays the same. A lender will determine how much cash you can receive with cash-out refinancing, based on standards such as your property's loan-to-value (LTV) ratio and your credit profile. How does cash-out refinance work? A cash-out refinance is a type of mortgage refinance that takes advantage of the equity you've built over time and gives you cash in exchange for taking on a larger mortgage. In other words, with a cash-out refinance, you borrow more than you owe on your mortgage and pocket the difference. Cash-out refinance example: if your home is worth $300,000 and you owe $200,000, you have $100,000 in equity. With cash-out refinancing, you could receive a portion of this equity in cash. If you wanted to take out $40,000 in cash, this amount would be added to the principal of your new home loan. What is the downside of a cash-out refinance? Foreclosure risk. Your home will serve as collateral for the cash-out refinance. If your new loan increases your monthly payment, you might have a harder time keeping up in the event your income goes down or your expenses go up. You could be at higher risk of foreclosure than if you hadn't refinanced. How do you take advantage of cash-out refinance? If you put the cash-out proceeds toward a project that increases the value of your home, the mortgage interest is tax deductible. Emergency expenses, such as an unexpected hospital stay or unplanned car repairs. Education expenses, such as college tuition. Consolidating and paying off high-interest credit card debt. How long does cash-out refinance take? A cash-out refinance typically takes 30 to 45 days to complete. However, the length of time may vary depending on the size of your property, how complicated your finances are, and how long it takes to complete your appraisal and inspection. How does cash-out work? Cash-out refinancing is when a homeowner refinances their mortgage to a new mortgage, typically at a lower interest, and in the process, borrows more money than what is needed to pay off the current mortgage. The first mortgage is paid off and the homeowner gets a lump sum payout of the extra cash amount at closing. What's the difference between cash-out and home equity loan? Cash-out refinances are first loans, while home equity loans are second loans. Cash-out refinances pay off your existing mortgage and give you a new one. On the other hand, a home equity loan is a separate loan from your mortgage and adds a second payment. Cash-out refinances have better interest rates. How many times can you refinance your home? How many times can I refinance my mortgage? There's no legal limit on the number of times you can refinance your home loan. However, mortgage lenders do have a few mortgage refinance requirements that need to be met each time you apply, and there are some special considerations to note if you want a cash-out refinance. When should I consider refinancing? A rule of thumb says that you'll benefit from refinancing if the new rate is at least 1% lower than the rate you have. More to the point, consider whether the monthly savings is enough to make a positive change in your life, or whether the overall savings over the life of the loan will benefit you substantially. How do companies refinance? When a company chooses to refinance its debt, it can do so by taking one or both of the following actions: restructuring or replacing the debt, generally with a longer time to maturity or a lower interest rate. Issuing new equity to pay down the debt load. Where does money go when you refinance? In the most simplistic explanation, the balance stored in your redraw facility is transferred to your new loan when you refinance. You will still have access to the funds you have accumulated in this facility, but now you might have to pay a slightly higher interest rate on the amount that you have drawn down on. Is refinancing a loan smart? It's possible to refinance a personal loan to save money on interest, lower your monthly payment, or pay off debt faster. That being said, personal loan refinancing isn't a good idea in every circumstance. You should run the numbers to determine if refinancing is the right move for your financial situation. Why do companies refinance loans? Corporate refinancing is a process through which a company can reorganize its financial obligations by replacing or restructuring existing debts. Some of the goals of corporate refinancing are to reduce monthly interest payments, find more favorable loan terms, reduce risk, and access more cash. Can you reverse a refinance? If you are buying a home with a mortgage, you do not have a right to cancel the loan once the closing documents are signed. If you are refinancing a mortgage, you have until midnight of the third business day after the transaction to cancel the mortgage contract. Why do banks do cash-out refinance? Investment purposes. Cash-out refinances offer homeowners access to capital to help build their retirement savings or purchase an investment property. High-interest debt consolidation. Refinance rates tend to be lower compared to other forms of debt like credit cards. Which of the following is a disadvantage to refinancing? Lowering your monthly mortgage payments. Refinancing allows you to lengthen your loan term if you're having trouble making your payments. The downsides are that you'll be paying off your mortgage longer and you'll pay more in interest over time. What happens if you cancel a refinance? If you do rescind your loan, your lender has 20 days after receiving your notice to begin the cancellation process. The lender has to refund any fees you've paid for your loan, including application fees and home appraisal fees that you may have paid upfront. Also, you have to return any funds you've received. What is the maximum cash-out refinance? 80%. It's common for lenders to allow you to borrow up to 80% of your home's value. This is also called your loan-to-value (LTV) ratio maximum because it measures how much of your home's value is being borrowed. However, eligible military borrowers may be able to tap up to 90% of their home's value with a VA cash-out refi.